Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Next up, the Planet MicroCap Showcase Vegas, happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino. Save that date. We are working our tails off behind the scenes to put together the best program we can. Announcements coming soon on initial sponsors, a couple speaker announcements. I'm extremely excited, but let's finish out 2023 and then we'll get there. So the website is now live. So if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. My guest on the show today is Erik Conrad, portfolio manager at Peapod Lane Capital. I was introduced to Erik by Doug Porter from Acuitas Investments. Thank you, Doug. And I had the chance to meet him recently in New York. Erik is a self-described extreme value investor. And while uncovering what that means to him, we started getting into his generalist strategy, investing in healthcare. We've been covering the bloodbath and healthcare biotech here at the podcast. And so I wanted to learn more about how Erik is approaching looking at a sector that's been beaten down. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with Erik Conrad. Erik, thank you for joining me today. How are you doing?
Hey, thanks so much for having me on.
Absolutely. No, we really appreciate it. And shout out to Doug Porter from Acuitas for introducing us. And, we actually had a chance to meet in New York when I was there to have a coffee and, meet up and talk a little bit. So I appreciate you jumping on here again and sharing some of the stuff that we also talked about, because I thought it was fascinating, some of the stuff you got going on in the micro and nano cap space.
Yeah, it's great meeting you, and happy to be on and happy to have the conversation.
Absolutely. All right. So let's kick this off. For those that, don't know you, haven't heard of Peapod Lane Capital before, can you give us a little bit about your investing background and then what led to your founding of Peapod Lane?
Sure. My quick background is University of Chicago undergrad, worked in MBA. I worked for Mary Gabelli Asset Management as an analyst after business school. I spent a few years at a hedge fund in New York after Gabelli. But I was always investing my personal money in off the beaten track, deeply out of favor, primarily micro and nano cap stocks that you had to figure out yourself, do your own research on. I get success doing it, and that led to the genesis of Peapod Lane Capital. And the way we look at the world, we're deep value investors, basically looking for stocks that are deeply out of favor. We have an asset-based approach. So for those of you who have read Graham and Dodd, we look for a lot of net type stocks, or things that, in today's world that sort of will correlate to net type stocks. And that leads us to the micro and nano cap space. That's where there's less competition, for all the obvious reasons. It's the do-it-yourself market. Limited buy side overlap, limited sell side coverage. Sometimes things get irrationally cheap, and that's what we do. We tend to have a portfolio of 50 names or so. Typical market cap is, our sweet spot is under 300 million market cap. Our typical average market cap is under 200 million. We're really looking for deeply out of favor, which is 50-week lows, multi-year lows, stocks where we think, or where we have a margin of safety on the downside, stocks that own assets. And that's really in a nutshell what we do. We're a two-person team. So I'm the portfolio manager. My partner Martin does trading, kind of everything else. And, that's Peapod Lane in a nutshell.
Very cool. Thank you for that full overview and kind of the high level look at how you guys do things. So I wanted to, firstly, it's so funny how, when you're at a bigger shop as an analyst, you're looking at the large cap stocks, but at night you're like, man, these small micro nanos are just so this is the good stuff, man. Like I just want to be doing that, but you can't when you're at those bigger shops, right? Like it is what it is,
Absolutely.
So, you said that, you guys are deep value shop, but I mean, on your website, you take it a step further. You say you're extreme value shop, so, you kind of alluded a little bit to your investing philosophy already at the beginning there, but, I wanted to better understand what you mean by extreme value investing. How is that even more down the rabbit hole than deep value investing?
I guess that's really a subjective question. So what we're really looking for is things that are, really baby thrown out with the bathwater. It's multi-year lows, 52-week lows. And the way we're looking at value, we're looking at low price to assets. So when we look for stocks, we're screening for low price to book asset stocks. It's very much of a, Graham and Dodd type strategy, or Walter Schloss, for those of you who are familiar with him. Stocks that have assets. In a lot of cases, it's just simply working capital trading at a discount. Other times it's real estate at a discount. Stocks where theoretically you could buy some of these companies and theoretically buy them at a discount to where they theoretically could be liquidated at. Not that we expect liquidation ever to happen, because that's just not the kind of the way the world works. That's not the motivations for the management teams and the board of directors to liquidate companies. But stocks where we can own them, discount to theoretical liquidation value, where we get the operating businesses for free or a super low price. So when we say extreme value investing, that's really what we're talking about. Stocks that are just so cheap, where the low price itself can be its own catalyst. And that's what we say when we mean extreme value investing. And we also say it to differentiate ourselves a little bit from, when people say value investing, it's usually low price PE, low price to cash flow, but we're low price to assets. So it's just our way of differentiating ourselves.
I look forward to reading your book one day. That's going to be right there next to Toby's book. For deep value, it's going to be extreme value. But I love that, especially from a marketing perspective. It's just so it's like 7-minute abs, 6-minute abs. But okay. So digging even a little further, because this is something that we talked about when we were having our coffee together, and I thought it was fascinating, and that really has to do with this contrarian approach as well to micro and nano cap value, and this idea of deeply out of favor. So for you, I mean, kind of touch on it a little bit here, but what are some of the metrics that you consider when you're saying, okay, I want something that's deeply out of favor? Here are some of the metrics that we're looking for when we do, some of our simple screens or anything like that.
Yeah. So our initial screen in terms of idea generation, we screen on the simplest thing to screen on is price to book. I mean, that's what's out there. Obviously book value is an accounting term. It's not necessarily economic reality, but that's what we can screen on. And we screen very broadly. So we screen stocks generally under 1 times book, usually generally under 1 times debt to equity, stocks that are hitting 52-week lows, stocks that are fallen by any great amount in any given day, as well as busted IPOs and busted secondaries. And from there, we get that list and we pull up balance sheets. 90% of the time, it takes us 5 minutes to say this isn't going to fit our, what we're looking for. But what we're looking for is, as I said, assets. For us, are they a net stock? That's really our bread and butter. But it's also, can we own real estate at a discount? Can we own land at a discount? So we pull up the balance sheet, pull up cash flow, we pull up the income statements as well. But it's where can we own assets at a discount? Where do we have margin of safety? Where are these stocks priced so irrationally cheap? A lot of what we do is also, we're thinking about behavioral economics as well. Why is something cheap? We all have our biases. One of which is, recency bias. Stock goes down. It's very easy to take out the ruler and think it's going to go down forever. But sometimes that's not the case. Sometimes, in a very simple example, the company may have $4 of cash, no debt, trading at $2, per share, and maybe that's an interesting investment. Maybe it has a business that makes sense, but it may have been IPO'd 5 years ago as a growth stock at 20, and now it's trading at 2, and people are selling just because it's gone down. It's not a growth stock anymore. There may be tax loss reasons going on. They may be getting kicked out of an index. So that's really what we're doing. It's a very broad screen, looking at trying to find stocks that fit what we're looking for. So everything we own in the portfolio there's going to be a lot of similarities to them. It's going to be, on the surface, there's going to be some reason why it's gotten cheap. It's going to be some reason why it's gotten so out of favor. But it's going to have hard assets. Make sure it be next, maybe cash at a discount, maybe real estate at a discount.
IP?
What's that?
Do you consider IP as part of that as well?
We don't. I mean, not on the downside.
Okay.
On the upside, we do. I mean, there's two questions there. So on the downside, we take a super conservative approach because we want margin of safety on the downside. But when we consider the other side of the question, okay, let's think about the downside. How do you not lose money? How do you make money? That's the other part of it. So what's the upside? How do you get to the upside? So the stocks we own are going to be trading at low price to book ratio. Mm-hmm. But when things turn, if we're fortunate enough they turn, sometimes they transition into an earnings-based company. And how do you go from that earnings base? How do you transition from a low price to book stock to one that's valued on cash flow or earnings? So yes, on the upside, we consider IP, we consider brand value, but when we buy things, we're taking a very conservative approach, and we're trying to protect our downside.
Well, the reason I ask, and I think you probably know why I'm asking that, is because the one thing we talked about when it came to, deeply out of favor, constrained. I mean, we were talking about your biotech strategy right now, yeah, where you bought a basket of some of these biotechs out there, because I think anecdotally, without even looking at any of, indices and performance or anything, I think everybody listening, we can all agree that biotechs have just been through the absolute, part of my French, the shitter. In the last 2 years, right? So, I asked that IP question just because, and that actually made a lot of sense when you said on the upside, right? Because especially in biotechs, it's, you're kind of basically, 50-50 in many respects, or it's event driven, so I'd love to hear your idea there when it came, what got you to your biotech strategy, wanting to buy the basket, and then, what about it was so deeply out of favor that it became interesting to you at a certain point?
Yeah. So, first off, we're generalists. So we're going, where is the opportunity today? What's cheap? What's out of favor? What fits what we're looking for? We have the process. We have something very specific we're looking for. So today, and really for the past 18 months or so, the biotech space has been, if you look at the XBI, it's been decimated. But within that, there are a lot of stocks trading at pretty big discounts to cash. So if you go back to the early days of, or I guess 2020, 2021, when you had a big bull market in these types of stocks, capital markets were wide open. You had a ton of money raised in IPOs and secondaries that went into these biotech stocks. In some cases, they've had drugs that have failed. Other times, they've just, whatever the bankers sold, just the tide turned, And here we are 24, 30 months later, you had stocks that IPO'd at massively positive enterprise values in 2021, trading at massive negative enterprise values in now 2023. And the question is, you asked the question about IP, do these companies have positive IP or do they have negative IP because they're just going to burn the cash, never have a drug they can take to market? I mean, and what the stock market's telling you or the public markets are telling you is it's negative IP. They're just going to burn the cash. Well, 30 months ago was the opposite story. So what's right? And where should these be priced? And so we own a basket of them. And the way we think about it, we're not trying to sit there and say, hey, is this drug going to work or not? Because we don't necessarily have the skill set to do that. But what skill set I do have, or I think I have, or I try to have, is I know what cash is. It's fairly simple. I know what the cash burn is. I understand behavioral economics. I understand why sometimes stocks get irrationally oversold. I understand the concepts of cigar puff investing, where sometimes there is a puff left in these stocks. And I've always invested in these stocks historically, usually on a one-off basis where there was a failed drug trial, where the stock may have gotten 50, 60, 70% discount to cash. And more times than not, they worked out for me. The opportunity today is much broader because you had that huge influx of capital raised into the sector. So that opportunity set today is significantly greater today than it was prior to 2020. So we do own a pretty big basket of these stocks. We've been fortunate to have good returns in them, but it's really, it's on the surface, how can someone like me own a biotech stock, right? What do I know about understanding whether a drug's going to work or not? But I understand that I can buy cash at a discount. Some of these companies have laid off a significant part of their staff, cut down their cash burn. So for us, I like the optionality. I like the risk reward profile, and we own a basket of them.
Very interesting. I mean, as part of your due diligence when you're looking at owning a basket, do you talk with management at all to get a better understanding of where they exist or where they're going, what kind of conversations they're having with big pharma? Because that's usually sometimes also the main catalyst, right? Is that big pharma is just waiting for, results, data reads, that kind of stuff.
Yeah. I mean, look, the reality is my assumption is management teams are going to maintain their salary as long. So you asked, we talked about it before. I take a conservative view. Look, I'm not going to say, hey, these are the best in breed biotech stocks, because companies are obviously not. Because why are they trading at 40 cents on the dollar of cash? They're not, there's a reason for it, right? But is 40 cents on the dollar of cash right? Or maybe it should be 70 cents on the dollar of cash, which is still a pretty big upside. But what I do know is they tell you when their trial results are going to come. Sometimes they've already happened and they've already said this drug's not going to work, and we've massively cut spending. Other times I know when that trial result's going to occur, so I can run the math to figure, okay, they have $1 of cash now. When they release those results, is going to be 70 cents of cash at that point. And what do they do? Either the results are good or they're bad, and something happens. So the reality is, it's just, I own a basket, and I'm not trying to figure out whether these drugs are going to succeed. I just know I'm trying to figure out when are they irrationally underpriced relative to what the balance sheet looks like, and relative to what the cash flow statement looks like as well.
100%.
I don't know if that's I don't know if that's a circular answer, but
no. That I think that pretty much. I mean, basically, it's like, look, okay, some people who listen to this, they like to talk to management when it comes to just any, microcap. Some, you know where you're kind of getting into. Some, for the most part, with biotechs, these, for the most part, it's somebody that came from big pharma. They probably have a higher salary than you would like. You know that they're doing whatever they can to keep that going in some respect, right? So you're kind of like, okay, I know this going in, but at the same time, like, there might be something interesting about this company where, 4 months down the road, they might have a data readout of their phase 2A or phase 2B. And, that could, like I said, that could be
and a number of times they're actually not even trying to develop anything anymore. Is they're looking to make an acquisition, to do a reverse merger, basically take the public shell and the cash and reverse merger into something. So some of the ones that have really worked out well for us, we've had one liquidate, we've had a few do reverse mergers that have done very well for us. And we've also had some where data that was thought to be terrible was, maybe not as terrible as initially thought. So, the outcomes, there are a variety of ways for these things to work out, just so long as we pay a low enough price.
Absolutely. So, there's a number of out of favor sectors right now. I'm just curious how you landed on, just quantitatively, just on biotech versus, let's say, junior mining stocks are just, every generalist just said no, or cannabis stock, no, not even getting the psychedelic stuff, or whatchamacallit, what's the other one? Crypto, no, like, based on that, why, how did you land here versus some of the other ones that are also out of favor?
At one point in my life, and earlier in my investment career, when I started being a value investor, I would have said, "How could I possibly invest in a biotech stock? How can I get past the fact that I'm investing in busted biotech stocks?" But they hit our radar historically, and at some point, we bought one, did well in it, bought another one, did well in it. Put another one, did well on it, and we have a formula that's worked. But the thing is about, like, say you talk about junior mining, the assets in this case is a lot easier to think about than a junior mining company, because it's cash. It's not that complicated. If I look at a junior mining company, what's the asset? They probably don't have a lot of cash. They probably have, I don't even know if they have a hole in the ground, but they have a pile of rocks someplace that is either worth zero or worth a lot. But if it's just a harder analysis for me. So you talked about the junior mining stocks, but in this case, our bread and butter is nets, and this is obviously not a classic Graham and Dodd net, considering the cash burn situation, but it is biotechs are stocks trading at a discount to cash and net working capital assets, and it's just an offshoot of the net type stock investing that we do.
Absolutely. So Erik, you mentioned how it's really your experience that has led you, like, all right, I know healthcare, or I know we've been successful in biotech. We've bought a few, maybe from a past experience, maybe that first experience investing in a biotech that you're currently not a shareholder of anymore, just as an example of your process. Do you mind going into that, or would you rather not?
Yeah, happy to.
Okay. An old one that you're not in right now.
Historically, so the opportunity today is a little different than it was historically. The opportunity stays. You had this huge amount of capital raised, and sectors falling way out of favor. In the past, it was a drug failure. So the stock would be down 80, 90%, and then, drift lower to down 95% lower. So it was, in some respects, what cash is, what the cash burn is, and what the stock price is. So I would historically invest in these types of stocks where I basically had a certain window, usually somewhere around 2 years or so, where cash delay less the burn versus the price I'm paying. I thought that gave me plenty of optionality for something to happen. And that's really how I thought about it. And, prior to and the early ones I invested in pretty much all worked out very well. They haven't all worked out. I don't want to imply that, but it's that. I mean, it's like, and I'm not trying to say like, I hate talking about the drug itself or anything like that, because that's not really what I'm trying to do. But it's results. The way this works out is results have been more positive, and reverse mergers and liquidations. Those things have happened, and they've all happened successfully for me.
Absolutely. Look, my main goal today was I wanted to give folks an idea of what a generalist biotech approach can actually look like versus like feeling that you needed to be, have a PhD or subscribe to, 4, biotech newsletters to, help you better understand. Which doesn't hurt, don't get me wrong, but,
Quite honestly, if I tried to do that, I'm not going to be able to. If I try to subscribe to biotech, am I looking at these as biotech stocks, or am I looking at these as cash at a discount?
Now that's the key point.
That's the key point. We're talking about biotech stocks, but really what I'm thinking is cash at a discount. And if you can get, but they're tricky because the outcome is there's a greater range of outcomes here, and that's why you own a basket of it.
Right.
Whereas a more traditional bread and butter, net type stock, which is the majority of the portfolio, the outcomes look different.
Absolutely. You must be a kid in the candy store, looking at, geez, how many sectors or companies within some of these sectors that are trading, at cash at a discount right now?
Yeah. I've had a lot of these conversations about them. I've had a lot of pushback on it, but to a certain extent, that's the opportunity, right? It's other people not being willing to do it, and other people thinking I'm an idiot for doing it. But that's okay, right? I make my own decisions, and
100%.
The results speak for themselves, and that's part of being an
extreme value investor. People giving you a hard time, like, oh man, there's so many things trading at cash at a discount. You're going biotech. It's like, well, I'm an extreme value investor, dude. Like that's just what we do. So, just kind of putting a bow on this conversation. Is there any final thoughts on that? Maybe for those who are out here who are like, wow, okay, now I'm looking at this. Like, what is there anything else that folks who are listening in should be thinking about when it comes to this strategy? Anything else that you think about when it comes to this? The turn. I don't know. Love
I don't know. Maybe let's talk about more broadly versus talking about specific to biotechs. It's like just keep an open mind. You might see a biotech stock, or it could also be, even other than biotechs, you had a lot of the busted stocks that were technology stocks also kind of look the same. These might be, outside your quote unquote circle of competence, right? But the question is, are they actually outside your circle of competence? And what is your circle of competence? So when I think about my circle of competence, it's not figuring out drugs and trials. It's figuring out assets, and when are those assets too cheap, and when can I buy those and earn an attractive return? That's my core competence. So something on the surface may look like, one thing, but the reality is something else. I think maybe just keeping an open mind is kind of the broad message, I would say. And you asked earlier about my history about these. It's really, just you have to just open your mind. At some point you say, I'm a net investor. I love cash working. I love buying working capital at a discount, and I would see these biotech stocks, and sometimes I would not follow them and say, at some point, let me try it. And it worked, and tried it the second time. It worked. And I was like, you have to keep an open mind. And, you see what's right in front of you may be one thing, but the reality, it might be something else.
Absolutely. So, not to, I try not to ask this as a crystal ball-y type question, but maybe, as my final question to you here for, because I've loved everything that we're talking about. I'm sure we're going to have you back on at some point in 2024 to discuss maybe what's deeply out of favor for 2024. Yeah. But, looking ahead a little bit, I mean, from some of the screens that you put out there and some of the things that you're seeing, is there anything that you're seeing, a sector that's looking deeply out of favor-y already going into 2024? Other than biotech?
Obviously, you've had the move in the past month, but retail, there's some retailers out there, and consumer. Some of those stocks are cheap and kind of fit our net type profile. We're really bottoms up investing, so it's a lot of the times it's not necessarily sector reasons something's cheap. It might be company specific reasons something's cheap. So it's we've had a good year. We've had good returns this year. But what's interesting about our returns this year is we have a number of stocks that are up a lot, but we also have a large handful of portfolio that really hasn't moved all that much. And that's hopefully the source of opportunity for 2024.
Very good. I think that's a great place to end it, Erik. Yeah. I mean, final thoughts, anything else that we missed today that you wanted to share, or think we're good?
I think we're good. I mean,
okay, cool. Well, then, Erik, with that, where can our audience go and find more information on Peapod Lane Capital?
Sure. We have a website, www.peapodlane, PEAPODLANE.com. Or feel free to give me a call, 917-658-4623.
Very cool. Well, Erik, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next interview.
All right. Thank you so much.
Thank you.
Take care.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.